Well, good afternoon, everyone. We are going to get started here. We got a full house, so thank you all for coming. This is an exciting time for us. This is a heavy lift for our team, but we do it for you, the business community. We want you to be able to advise your clients, advise your customers, advise yourselves to making good decisions moving forward. 2022 was a crazy year for us, but I guess before I get started, I want to say a couple quick thank yous. For over 2 decades now, Summer Hoffman's had a tremendous amount of impact on the slides and coordination and everything. So thank you to Summer Hoffman, as well as Sarah Wolfswinkel and Ellie Aldrich this year had a big impact and a big part of putting this thing together. So a big thank you to our team. Now, thank you. Also want to say a quick thank you to Michael and to Andy. They're not presenting today, but they definitely have an impact. Even into this last week, Michael's sending articles and supporting this narrative. And so just a huge thank you to them as well. Yeah, from Florida. All right, let's get started. 2022 was a year of paradox. It was a crossroads. Sorry, I have a clicker this year. This is new for me. It's a new era of investing. For the last decade plus, we've been incentivized to invest. We've had physical checks coming to our homes and to our businesses. And we've had the federal, we've had quantitative easing, what's led to negative real interest rates. Unregulated crypto markets had an impact here as well. And the Fed this year put away its pickaxe and brought the sledgehammer. Essentially, a year ago today, they had not even raised rates yet. And they essentially went from 0 to almost 5% in the last 12 months. That's led to some inverted yield curves and some other issues that we're gonna talk about today. On top of all that, we've got geopolitical issues, Chinese spy balloons, tension in Taiwan, China and Taiwan relationship, and the ongoing war with Ukraine and Russia. We get asked all the time, when are we gonna see value in the marketplace from a buying perspective? When do I feel good about buying real estate? We've had an all-time run up in ag land, residential, commercial, and I'm gonna touch on that in my predictions here in a little bit. Speaking of a new era, it used to be buy one, get one. Now it's one for the price of two. On top of that, the Fed's printed some new $1 bills. What do you guys think about these? My personal favorite, 2022 was a good year. Gave my kids popsicles. I got a dozen Pro V1s every time they were done. It was good. All right, let's get started. When we talk about mixed signals this year, we're gonna look at unemployment growth, employment growth, job openings. The big white elephant in the room is inflation. We have to talk about inflation. We're gonna look at bank deposits again this year, and then we're gonna drill down into the Sioux Falls economy. Employment growth. Probably not a big surprise to anybody in here. It's a tight labor market. Sioux Falls finished the year at 2%. We generally track right at 50% of that national number, which finished the year at 3.6. Now that's a 53-year low. It's been since the late 60s. Since unemployment's been at 3.6%. It's a tight market. Let's take a look at employment growth. Not a whole lot on this slide to take away here, but we talk about how Sioux Falls is pretty resilient. Even in the face of a pandemic in 2020, we had a small blip and we picked it back up right away as the national number dipped down a little lower. Let's talk about job openings. Right now, there are 10 million job openings in the United States. There are 5 million unemployed people. When we talk about inverted curves, this is another one. Clearly, it's an expanding economy when the labor market, you guys, the business owners, continue to feel confidence and continue to hire people. When I look at charts like this, I don't think the Fed's anywhere close. They need to destroy demand further. They're not close to being done raising rates yet. But we started to see some cracks last year, especially in the technology sector. Several Fortune 500 companies have announced mass layoffs. Especially in tech. There was over 100,000 jobs that were laid off. Those are high-paying jobs. Some have deemed this the white-collar recession or a rich recession where it is impacting the upper middle-class families. I'd watch the rest of this year for for this to start trickling down in some of these other sectors. Another thing, another trend to watch this year is going to be a thinning of the herd. Some of these Fortune 500 companies or large companies don't want to announce mass layoffs, but they're going to force some people back to the office, which they know will thin their herd. So just watch for more announcements on that in 2023. All right, there's inflation. Let's talk about it. It's no surprise to anybody in this room, the CPI finished at about 6.5%, 6.4% for the year. What I want to focus on is your PCE, that lower one today. That finished the year it's a personal consumption expense. So that's your CPI, it's less food, less energy, and it's really more from the business side, the supplier side, as opposed to the consumer. That's the one the Fed is watching. That one's gonna have to be below 2% before they stop raising rates. So follow that one this year. PPI, Producers Price Index. That's your commercial construction costs. In 2021, had a huge run up. And there was a pullback in 2022. Finished the year at 6.9%. Now, if you talk to most of the large commercial contractors in town, they'll tell you that probably 2/3 to 3/4 of that number is in wages. We think the Fed has a wage problem more than they have a pricing problem. Why do we say that? Let's take a look at some commodities. Now, this is lumber. Lumber's measured per 1,000 lineal board feet. Take a look prior to the pandemic. It was about $500 per 1,000 lineal feet. Massive run up. And I will say, I don't want to steal Nick's thunder here, but we could have basically overlaid the money supplies chart on all of these charts, and we would have had a pretty simple presentation. But I gave Nick the money supply slide, so he's going to touch on that in the investment markets here in a few minutes. But the lumber's pulled all the way back down to where it was pre-pandemic. Let's look at steel. Now, steel and lumber are two of the core components in commercial construction. Now, this is hot rolled steel measured per ton. Again, pre-pandemic, it was around $500 a ton. Big run up, it's pulled all the way back down to about $750. Let's take a look at the supply chain and transportation costs. This is the cost of shipping a container from China to the Western United States. Prior to the pandemic, it was about $4,000 to $5,000 to ship your container here. It peaked at around $19,700. It's pulled all the way back down. It's less than what it was prior to the pandemic. The supply chain is starting to be worked out. Rob's going to touch on supply chain and the industrial market here as well in a little bit. So bank deposits. Last year we talked about the money supply that had come in. These banks got really healthy. And last year we gave the stat of the top 10 community banks in Sioux Falls had grown their deposit base by around 44% in the last 18 to 24 months. Now, when you think about that, these are century-old banks, and their depository base was basically changed overnight. We're starting to see some pullback. For the first time in the last 10 years, we've seen 2 consecutive quarters where the money's being pulled out of the bank. This is an FDIC chart, national number. Almost $500 billion has been pulled out. Where's that money going? Well, the Fed quit playing offense. We're not getting checks anymore, and so we're all paying more for goods and services, and so we're some of that is being offset by higher inflation and consumer spending. But if you go back to January of 22, fixed income was essentially no income, and by the end of the year, fixed income became at least a little bit of income, 4 to 5% returns, and so we're seeing some of those dollars are going into the US T-bills and to some fixed income assets. Sometimes when you talk about mixed signals, it's just where are you at? This is a chart of W-2 employees change from January of 2020 through November of 2022. Take a look at South Dakota, 3.5% growth. It feels good. South Dakota business feels good right now. Look at North Dakota, 1.5% reduction. That's probably mostly due on the western side of the state from the energy sector, or you could just make the argument that those crazy bison fans are just moving to jackrabbit country. Congrats on your championship, by the way. Now take a look at Texas and Florida, 5.5%, 6% growth. Now look at New York. It doesn't feel the same. Okay? We're going to spend a little time now looking at residential real estate. Why are we talking about residential real estate at a commercial real estate conference? Well, when you talk about CPI and the inflationary growth, this is roughly a third to 40%. The largest core component of CPI is housing. This is a chart going back 50 years. The average mortgage rate, 30-year mortgage rate in the last 50 years has been 7.75%. If you were like me, you're a millennial born after 1980, we didn't start buying homes until the mid-2000s. We don't know anything but 4, 5s, and 6s, maybe even less. Recently, an executive in town said that he's had 4 mortgages in his life, 13.5, 11.5, 9.5, and 7.5. Felt like he hit the lottery every time. His son, who's about my age, said 3, 6, 4.5, and 3. This is going to be the new normal. What does that mean for, and currently today, it's roughly 7%, just under 7% for a 30-year mortgage. What does that mean for buying power? What does that mean to Sioux Falls? Let's go back to January of 2022. The average 30-year mortgage rate was 3.2%. If you could afford $2,000 payment, principal and interest payment, so you had a family household income, maybe $80,000 to $100,000, you could have bought a $460,000 home. Fast forward to December, 12 months later, that same family, that same $2,000 could only buy a $320,000 house. It's a massive lost buying opportunity. Let's see what happened in Sioux Falls. January 2022, now this is all residential closings, refis, and new purchases. In January, there were 634 closings for a total loan volume of about $135 million. 12 months later, exactly cut in half. And about $81 million, a 40% drop in loan volume. Residential real estate is on the front lines of fighting the Fed. The builders, those owners, buying a new home, they're right on the front lines. And the commercial sector is going to lag 12 to 24 months behind that. Now we're going to look at some building permits. For the first time ever, we broke out apartments here. Last year, huge number, almost $500 million of apartments were built in Sioux Falls. Now I want to draw your attention all the way over to 2012. Okay, 2012, that our combined commercial construction, commercial, residential, remodel, new, everything, including a $100 million event center, was $500 million. So that in 2022, 10 years later, we built $500 million in apartments, just an astounding number. Nick's going to talk more about that in his presentation. One of the things we noticed, we want to talk about large projects over $20 million. No one in here would argue that it felt pretty good from 2013 to 2020 in Sioux Falls. We averaged 3 to 4 large projects that built a year. 2021 came along, the first time we ever went over $1 billion, 9 projects over $20 million. 2022 told 2021, hold my beer, we have 18 projects over $20 million. And I bet some of you are saying, I bet those are all those apartment buildings on the outskirts of town. 4 of them were. The other 14 were in other areas of the market. What it tells me is you have 18 people, 18 city leaders, 18 investors, 18 bankers that are betting big on Sioux Falls. We're going to watch this trend and watch this to continue to grow. Now we're going to break down new commercial construction. There's the blue line there. That's your apartments again, that $500 million. The purple line is your other. That included a $170 million investment in the wastewater treatment plant. And if you look at the other 3 sectors, the core of commercial real estate, industrial, retail, and office, they all had really solid years in 2022. Let's take a look at new commercial construction versus addition remodel. What we want to focus on this slide is the disparity between the two. In an expanding economy, new commercial construction will outpace addition and remodel. Draw your attention to 2020. At that time, that was the largest disparity we'd ever seen. In 2022, we had to add about 4 columns to the top of this thing to fit this in this chart. Clearly, it feels like we're in an expanding economy in Sioux Falls. How do we compare within the region? There's that number again, $1.9 billion of building permits. almost beat Des Moines. That would have been fun. But there's $9,500 in Sioux Falls for every citizen. So it's a huge per capita number. Take a look at Rapid City. Last year, Rapid City was over 500 million. There's a slight pullback. I would have expected that number to be around 20 to 30% higher than it was. One quick note here, Lincoln, Nebraska. We probably reached out to them, inquired for this number at least 10 times in the last month and a half. They just got it this week. I don't know what they've been doing in their planning department. Maybe they've been looking for a football team. But but it made me very thankful for the city of Sioux Falls. They are prompt. On the first of every month, we get this data, we get this number. So thank you to the city of Sioux Falls. It's a great city to be in. Population, none of this is possible without population growth. And population growth means job growth. And it means you all continue to grow, continue to hire people, continue to have confidence in this market. Last year, the city of Sioux Falls grew by about 6,700 people. Go back to 2013 through about 2020, 2019. And we used to say the city of Canton, 3,000 to 4,000 people were implanted into the city of Sioux Falls every year. Now it's more like Madison. 6,000 to 7,000 people are coming every year. And that's just in Sioux Falls proper. If we add the outlying areas, that number is probably closer to 8,000 or 9,000. We're truly becoming a metro area. Some predictions. Where are we going? We do think that recession is coming. Some headwinds are coming. They're on their way. Maybe they're already here in some sectors. Be prepared to take advantage. However, there's no other city I'd rather be in. There's no other state I'd rather be in. There's no other business community I'd rather go through any headwinds with than in Sioux Falls and with you. The business climate is 72 and sunny here. The Fed funds rate, where are interest rates going to top out? They're at 4.75 today. The Fed meets again in 2 weeks. They're going to certainly raise 25, maybe even 50 basis points at that point. I think it'll be 25, and they'll do at least 2 more 25s in May and then this summer. And I think they'll probably push pause at that point, but we don't know. Inflation feels really sticky, and we've gotten a lot of mixed signals. Now, Nick and I were arm wrestling. When I originally wrote this slide in January, I said the 10-year Treasury is going to be under 4%. Today and yesterday, I had to adjust this slide to 4.5%, and Nick won that bet. So, value in the marketplace. When do we get to see value in the marketplace? When do we feel good about finding a good investment property or finding the value again? It's going to take a little time for the sellers to reset expectations. It's going to be 12 to 24 months. With that concludes my portion of the presentation. I'd now like to bring up Braden Nisus to present on the land market. Thank you.
Well, thank you, Reggie. As Reggie said, my name is Braden Nisus, and I'll be presenting on the land market here in the Sioux Falls area. We'll start the presentation talking about unimproved land sales. We'll jump over to improved land sales. We'll talk about some pricing, and then I'll make my predictions. Let's get started. In this graph, it represents the number of transactions that have taken place historically, going back to 2010. Obviously, 21, we had a banner year where our number really escalated quickly. I personally had a similar year in 2021. With a 1-year-old at home, my wife and I found out that we were having twins. So our family growth kind of felt that way. Let's look at last year. Last year, we came in at just under half the transactions that we had last year, but still the second best year, still a solid year in unimproved land. Let's take a look at where these took place. In this area, you'll see the blue dots representing the past transactions, and last year's transactions represented in the gold stars. Let's highlight some of the pricing. Starting up there at the top, 40 acres purchased for $40,000 an acre. That was out by Willow Run. That's a good buy. Moving down, 62 acres purchased for $60,500 an acre. That's the city of Sioux Falls purchasing land right along South Veterans Parkway for the future right-of-way, as well as future detention ponds. And then lastly, one more, 21 acres purchased for $75,000 an acre. That's Avera purchasing the corner of Southeastern and South Veterans Parkway for their future development. Let's jump to the other side. We'll start there in the middle, 32 acres, purchased for $430 a square foot. That's a developer, mainly gonna develop it for himself, a lot of twin homes and multifamily. And then there's also commercial opportunities being on the corner of 41st and T. Ellis. Moving north, 315 acres, purchased for $45,000 an acre. That is a large transaction on our northwest side of Sioux Falls. Continuing north, that's the Development Foundation exercising their option to purchase 133 acres at $18,000 an acre for their future offerings. And then lastly, 200 acres purchased for $30,000 an acre. That's the park anchored by McGuire Iron. One thing to note on that, roughly a third of that park is able to be developed today due to sewer services. The rest of the park is gonna have to wait until the city brings those services to the rest of the park. Let's look at some more data. This graph, it represents the number of acres that were purchased each year. Obviously, 21, we had our big year. Last year, we came in at just over 1,000 acres. What does this data tell us? Where's the story? Well, I think the story really lies on what we don't see in this data. In our office alone, we had 520 acres that were under contract and had a closing date for 2022. And those developers decided it wasn't the time to move forward with those and canceled the deal. Why did that happen? Well, I think Reggie touched on a lot of why it happened in his presentation. Mixed signals, creating uncertainty, and then interest rates, not only affecting the developers themselves, but affecting their customers, the home buyers. Reggie touched on residential sales trending down, and I think the developers are catching wind of that. We'll continue to watch that and see how that affects us going into 2023. Let's jump over to improved land sales. As defined, those developers take those large land transactions, they do the dirt work, they add infrastructure, utilities, water, streets, gutters, and they break them down to a smaller parcel and sell them on a per square foot basis. Let's take a look at the data. In this graph, it represents the number of transactions as well as the sales volume. And you can see that we essentially had the exact same year as we did in 21. We had 89 total transactions, and we came in at just under 90 million in sales volume. Let's break these down in the different asset classes. We'll start with office. There in the gold bar, 3 transactions last year, which is a historic low. And you might be saying, well, Braden, that's because everybody offices from home. We don't need office anymore. I think that's part of the story, but I think there's more to it. A couple of examples. Our suburban market, we don't see a lot of land transactions anymore. We see land offerings and then the developer building the building and selling the whole package. And then also the users of our traditional users for office, particularly our medical users, they're not looking for office sites anymore. They're looking for retail sites for the accessibility for their patients, as well as the visibility for their business. So that's an interesting trend that we'll continue to watch for. Moving on to multifamily. Multifamily, we came off a historic high, and we're leveled back down to kind of what we typically see, 10 transactions in our market. Retail, we had a solid year, 30 transactions, not a lot of excitement in the retail, just kind of a good year. And then lastly, industrial. Industrial, we had 45 land transactions last year. That's more than half of all the transactions that took place. One thing I want to point out, look at the last 3 years in industrial compared to the rest of the graph. That's a lot of demand in our industrial market. That's over 100 transactions, 106 transactions in the last 3 years. I'm going to continue to talk about this as we move forward, so keep that in the back of your mind. Let's talk pricing. Retail. As I said, retail just kind of had a solid year, and the pricing reflect that. Not a lot of change in our retail market in the land. Office, we did see a big hike in the price year over year, but keep in mind we had 3 transactions. So one transaction at 16 really pushed that mean up, comparing it to last year. Multifamily, we saw a large disparity in the pricing from high to low, which we typically don't see in that market. One thing I'll point out, looking at the data, there was really 2 outlier sales that affected that. and really controlled by one user, one group. They purchased land at $7.55 a square foot, and then turned around, sold it a couple months later to the partnership at $12.15 a square foot. So take those two sales out, and we're back on kind of average what we have in our multifamily. And then lastly, industrial. What I want to focus on here is comparing it from year over year. We had just about a 30% increase in our industrial. And keep in mind, we had large data sets for each year for 21 and 22. Why did that happen? Well, I talked about the demand. Let's talk about the supply. Where are all the industrial lots? Well, you might be thinking, well, we have the Development Foundation, and they have Foundation Park, and there's 400 acres out there. That's true. But the Development Foundation has really turned their focus to offering their parks for large users, which I don't think is wrong. They're trying to help our growing businesses, and as well as attracting large regional and nationals to our community. So what does that do here locally? Well, last year I mentioned we had 45 transactions. Of the 45, 40 of those were less than 10 acres. If we add all those up, that equates to 127 acres that were purchased just last year. Now, when we put this data together, we did an availability study to go on the open market, see what's available for less than 10 acres in our industrial market. We came up with 158 acres. What does that mean? That means we only have 15 months supply of our industrial land. There's some opportunity there for somebody, which I'll touch on in my predictions, which you can go to now. Start unimproved land. Now, I gotta be honest, I struggled a little bit trying to figure out where I wanted to go with this. And brought me back to the same feeling as trying to predict the upcoming season as a Nebraska football fan. I'm thinking we're gonna have a good year, but knowing we're probably not. I have us down. Again, we're trending down. Our residential sales are trending down, and I think there's gonna be some pause, but I don't think it's gonna be a doom year, but it's not gonna match the historic highs that we've had the last 2 years. Industrial, I think we're gonna have a down year. Again, I think the demand is there, pricing is going up, and our supply is limited. However, I think we'll see some private developers really turn their focus to industrial and bring more industrial offerings. And I also look to see our local economic groups in our surrounding communities really accelerate their plans to try to get their parks on the open market as well. Retail, I think we can continue to be steady. Office, we had 3 transactions. I think it's safe to say we're gonna be at or just above that in next year. And then lastly, multifamily. Multifamily, I think we're continue to see kind of what we have in the last few years, back to that average around 10 sites. So that concludes my presentation. With that, I'll bring up Alex Soundy to present on the office. Thank you.
Thanks, Braden. Now, first off, I'd like to say that I really do think this is our year as Nebraska football fans. I'm optimistic, I'm happy, go Big Red. All right, with that, let's get into it. My name is Alex Soundy, and I'll be talking about the office market today. A quick outline of what we will be going over in this part of the presentation. We'll first take a look at the national market and some trends that we're seeing. Then we'll look at the Sioux Falls market as a whole before breaking out the central business district, the suburban market, and then finally I'll leave you with my trends and predictions for the office market going into 2023. Let's get into it. Prior to the COVID-19 pandemic, 75% of employees had never worked a day remote. Fast forward to today, 66% of employees say that they work remote on average of 1 day a week. This has started a game of tug of war between the employer that's trying to bring their employees back to the office full time and the employee that's trying to protect that right to work remotely. Now, how convicted are these employees that want to protect that right to work remote? Surveys show that 23% would take a 10% reduction in their salary. 21% will give up vacation time, and 16% would give up employer matching retirement contributions just to work remote. Now, if you're an employer and you're trying to bring those employees back to the office and you don't want to utilize the heavy-handed approach, think about reinvesting in your office space as a way to bring that employee back to the office. Let's take a look at that. Now, first off, I'd like to note that originally I planned to have a bunch of cool pictures on here demonstrating different ways that employers invest in their office space. But being that last year, I was the first presenter in Market Outlook's 25-year history to be sued for copyright infringement for a picture that I used in my slide deck. I've now been restricted to using infographics moving forward, so. All right, so let's just use our imaginations here instead. So let's think about what this fun office environment will look like. Think more collaborative spaces, think ping pong tables and golf simulators, catered office lunches, office happy hours, open door policy with management. These are ways that employers are trying to bring those employees back to the office and give them an environment that they don't necessarily have working remotely. So if you're a landlord dealing with high vacancy, or you're an office developer bringing new product to the market, what's that mean for you? That means tenants are looking for high quality office space with good amenities. So what's happening to that Class C office product? Well, first of all, guys, more infographics here. So this is gonna be a trend throughout the presentation. So we're still seeing conversions from a lot of those office towers in big cities being converted to residential apartments. We're seeing those call centers be converted to industrial warehouses and manufacturing facilities. And in some cases, in markets where there's limited infill land availability, we're actually seeing developers buy these buildings just for the value of the dirt to redevelop the site completely. This is a trend that's going to continue nationally, and I actually see this trickling into Sioux Falls. Let's look at Sioux Falls. The Sioux Falls office market has 8.9 million square feet of tenant-occupied office space. That makes up about 52% of the total amount of office space we have in Sioux Falls, which is 17.2 million. We saw our vacancy rates dip up about 3.5% from 9.6% in 2021 up to 13.2% in 2022. Now, a few things caused this. We had a lot of call center space hit the market. I'll talk about that a little later. We also had two huge additions to our central business district with the Steel District and Sharapa 2. Those two projects added a combined 320,000 square feet of Class A office product to our market. That's also why we saw that Class A vacancy rate jump up from 3.3 in 2021 up to 12.3 in 2022. I'll touch on asking lease rates as it pertains to each sub-market here a little later in the presentation. Let's take a look at office sales. All right, in 2022, we saw 42 sales transactions for just under $83 million, coming in just under the 50 sales transactions for just above $90 million that we saw in 2021. Still a really solid year for the office market in Sioux Falls. Now, what caused this? This was caused by investors looking to the office market as an alternative asset class for yield on their capital. This was also caused by owner-occupants continuing to invest in their business and purchase buildings rather than lease them. Now, going into 2023, I do anticipate the high interest rate environment is going to keep a lot of those investors at bay, keeping our office sales down from what they were last year. But the sales that do take place are going to be driven by owner-occupants. Let's take a look at a few of those sales last year. On the screen, you'll see the Chamber of Commerce building. The Chamber purchased this building. They were previously a tenant, and they purchased this from their landlord for $5.7 million this past March. On the screen is a 35-year-old Class C office complex at 49th and Louise. This was purchased by a local investor as a value-add opportunity this past July for $4.2 million. Now, at $88 a square foot, this is a great purchase. Watch for this building to be repurposed or reinvested in the years to come. Here's an example of a local investor looking to the office market as that alternative asset class for yield. A local investor purchased these two buildings for $1.2 million each this past December and is currently working on leasing up the buildings. This is going to be a great long-term buy for this investor. Let's look at our central business district. Now, the narrative for the past couple years has been how Sioux Falls is growing, that our downtown is no longer just a downtown. We've actually added submarkets. In the gold, you'll see our downtown, our uptown highlighted in blue, East Bank highlighted in green, and the new addition of our Riverline district highlighted in red. I'll touch on that new project a little later. Let's look at the numbers. Our central business district has 2.67 million square feet of tenant-occupied office space. I'll touch on vacancy rates a little more in the next slide, but the main thing I want to highlight here is the 200,000 square feet of net absorption we had in our central business district last year. This was caused by the Steel District and Sharapa 2 adding that 320,000 square feet of new office product. Asking lease rates for Class A product continue to climb with the increasing cost of new construction, settling in at $30 per square foot in some of those new downtown developments. That's a record asking lease rate for the office space in Sioux Falls. Let's look at vacancy. Now, I do want to point out, you'll notice this year's the first time we separated Class B and Class C when looking at vacancy. In the past years, we've separated both of those and we've lumped those together. But with the new additions of the Steel District and Sharapa 2, among other large Class A developments, it's really changed what we view as Class A office space in the Sioux Falls market. Therefore, it's caused kind of a reclassification across all of our office class, giving us enough data to actually separate Class B and Class C when looking at vacancy. So this is going to be something we keep track of moving forward. Now, I want you to look at that gold bar. That is the Class A vacancy rate in the Central Business District. Prior to this year, we had a sub 5% Class A vacancy rate in our Central Business District dating back to 2016. It is safe to say that the demand was there for the additions of the 320,000 square feet of Class A space that the Steel District and Sharapa 2 brought to our market. And what's truly impressive is with that large addition, we only saw a single-digit increase in that Class A vacancy, up to 11.2% in 2022. Shows the health of our downtown and the demand there was for some quality office product. Now, the real Cinderella here is the owners of Class C office space in our Central Business District, coming in with the low 4.5% vacancy rate. Now, I think the reason for this is business owners and tenants wanting to be a part of our vibrant Central Business District, but not pay the high lease rates for that Class A and Class B office product with those high finishes and those Class A amenities. Now, I see this trend continuing as our downtown continues to grow and the excitement continues to be there. I think people are going to sacrifice those amenities for a lower lease rate just to be part of that vibrant downtown. So watch that staying in single digits for the next couple of years. Now, I've already touched on it a few times in this presentation, but it truly is impossible to talk about our Central Business District, let alone Sioux Falls, without further highlighting the additions of the Steel District, which you see on the left side of the screen, and Sharapa 2's Bank Court building on the right side of the screen. Between these two projects, they're bringing that 320,000 square feet of Class A office product to our Central Business District. Now, last year when I talked about both of these projects, there was already some notable tenant announcements that were public. You had Eide Bailey, C&B Operations, Bank Court, Market Beat. But there was still a lot of space in both of these buildings that had to be leased up and filled. Now, as it stands today, 80% of the combined square footage of these buildings is leased or has a letter of intent in place. That's incredible. That shows the demand that there is for businesses to be part of our Central Business District. This is no small feat, guys. This is truly impressive, and watch for the rest of that vacancy to be filled up going into 2023. Now, speaking of momentum in our Central Business District, a lot of you have probably heard about the addition of the new Riverline District, which is going to completely redraw that eastern boundary line of our Central Business District on the east side of the 10th Street Viaduct. Now, it's yet to be determined what this public-private partnership is going to consist of, but there's been a committee made, and they're currently taking public input for ideas and concepts for what this could become. So watch for some cool announcements as it pertains to the Riverline District going into 2023. Now let's look at our suburban market. Our suburban office market has 6.2 million square feet of tenant-occupied office space. I'll touch on vacancy rates a little bit in the next slide, but the main thing I want to highlight here is that negative 153,000 square feet of net absorption. This was driven mainly by call centers. We'll look at that in a second. Vacancy rates in our suburban market. Now, once again, I want you to look at that gold bar. That's that Class A vacancy rate. Last year in 2021, ended the year at 3%. We had a jump up to 11.4% in 2022, and that was caused by a couple things. There was demand for some new office product, and we had a lot of developers that brought that. some large new office speculative complexes in the suburban market that are still being leased up has caused that vacancy to increase, as well as some larger tenants such as Bancorp, who are leaving their footprint in the suburban market to occupy new space in our downtown, in this case, the Bancorp building in Sharapa. So watch for those spaces to be leased up and watch for that Class A vacancy rate to dip back down to the single digits for 2023, as there still is a lot of demand for quality office space in our suburban market. Now, unlike Class C office space in our central business district, Class C office space in our suburban market doesn't look too great. We've had that vacancy rate continue to tick up year over year, settling in just under 22% in 2022. Now, there's a few things that cause this, but this is mainly being driven by call centers. Let's take a look at that. So as it sits today, we have 240,000 square feet of call center space that is on the market for lease. I actually had to add an additional 55,000 square feet to this slide on Monday because another call center hit the market. We have an additional 150,000 square feet of space available for sublease. Now, last year when I presented, I highlighted a term called shadow vacancy. Shadow vacancy is these larger office complexes with empty parking lots during business hours that look vacant, but they're not showing up on our vacancy report yet because there's technically a tenant with a lease in place that is still paying rent, so it's not a vacancy. Sublease space is an example of that, where there's a tenant that's paying this lease, but they're looking for someone to backfill that space. We have an additional 200,000 square feet of call center space available for sale. So all in all, in Sioux Falls, we have just under 600,000 square feet of available call center space. That's a big number, guys, and that's a number that's gonna continue to grow. Watch for some of these call center buildings be purchased and repurposed or reinvested in the next couple of years. So how does Sioux Falls compare to the national market when looking at vacancy? Sioux Falls ended 2022 at 13.2% vacancy, coming in under the national vacancy rate of 17.5%. But what I'd like to highlight here is this is a time where a lot of these big national markets have pressed pause on office development. They're uncertain, they don't know what to do, and they're not developing because there's a lot of employees that haven't really come back to the office yet. Meanwhile, in Sioux Falls, just look at our downtown skyline. 320,000 square feet between the Steel District and Sharapa 2, and we're absorbing that space and we're staying below the national market when it comes to vacancy. This just shows the health of the Sioux Falls market, especially in the office class. This is a trend that I continue to see moving forward, Sioux Falls staying below the national market with vacancy. Now let's look at some trends and predictions for the office market. I predict the Class A lease rates are going to continue to climb with the increasing cost of new construction. I think Class C suburban vacancy is going to increase as well. This is mainly going to be driven by those call centers hitting the market. I think our sales transactions are going to be down this year compared to the last few years. Like I highlighted earlier, this high interest rate environment is really going to keep a lot of investors at bay, but the transactions that do happen will be driven by owner occupants. I think there's going to be continued momentum in our central business district. There's a lot of excitement going on there right now. That's going to be also driven by some major announcements in the Riverline district. So watch for some cool announcements that come up. Will we see a sports stadium downtown? And lastly, Sioux Falls has always had an extremely healthy medical office market, and I expect that to continue going into 2023. So where does that put Sioux Falls on the real estate cycle for the office market? Well, with increasing vacancy rates, high new construction, and steady employment growth, I have Sioux Falls toggling the line between expansion and hyper supply, and I imagine it being there through the remainder of 2023. And with that, that concludes my presentation on the office market. I'd like to bring Rob Kurtenbach up to talk about the retail market.
All right, thanks, Alex. As he said, my name is Rob Kurtenbach, and I'll be presenting on the retail market for today's presentation. Let's take a look at what we're going to cover today. We'll start out talking about inflation and how our retailers are responding to that. We'll look at City of Sioux Falls sales tax data. We'll hit our vacancy rates, our property sales, and we'll finish up with some trends and predictions. Well, I think we all know inflation impacts all of us, and that's no different for our retailers, and that's forced them to get creative on how they keep their bottom lines profitable and their investors happy. The result of that is a couple examples here is shrinkflation and skimpflation. Shrinkflation on the left side of your screen, that's us as consumers paying the same for a product, but we're getting less product. Skimpflation, on the other hand, is really driven about quality. It's about the quality of the product or quality of a service that is offered. Let's take a look at a few examples of each. Now, shrinkflation, again, we're talking about getting less product. So I don't know about you, but I don't count the Fritos that come in my bag of chips when I buy those, but reality is you're getting 5 less Frito chips per bag. Now, it doesn't seem like much. It's 5% less, but to the company, to the retailer, multiplied over thousands of bags of chips or even millions of bags of chips, it's pretty substantial. Look next at the Crest 3D white toothpaste. You're probably not looking at the tube of toothpaste and figuring out how many ounces of toothpaste you're getting, but it's gone from 4.1 ounces to 3.8 ounces, about a 7% decrease. A can of raisins, you're getting about 70 less raisins than you're used to. That's about an 11% decrease. Again, this is the retailers reducing the amount of product that they're giving you while you're still paying the same. And lastly, I don't want to create another toilet paper crisis, but the reality is that you're getting about 20 sheets of toilet paper less per roll today than what you were used to getting. Now, I have one more example. It may or may not be true, but I want to show it to you anyways. So this is a little bit more of a dramatic example of what shrinkflation is. Now, this company had to adjust their name to make this work. So I want to introduce to you the newest 99-cent bag of Skittle. So, and at minimum, they could have at least done purple or red. Green's got to be the worst one there is. So times are getting tight, guys. So let's look over at skimpflation. Again, this is more about quality and a reduction of that quality in a product or in a service. If you stayed at a hotel in the last couple of years, you've likely noticed that in most hotel chains, you're not getting daily housekeeping as part of your stay. Same goes for fresh towels. If you want fresh towels every day, you got to call down to the front desk and request that. Now, this was a trend that really caught some traction during COVID as an effort to keep hotel guests and hotel staff separate. But here we are 3 years later, and this is still happening in most hotel chains. And what's driving that? It's really the hotel chain's bottom line, and it's also a staffing issue. Let's look at another example. Free shipping. I think most online retailers are still offering free shipping, but they're changing how they offer it. How do they do that? Well, you used to get your product in about 3 to 5 days when you got free shipping. Now you're getting it in 7 to 10 plus days. And so what's happening is when you get to the checkout page, there's now this little option to pick primary shipping option to pay a little primary fee to get your, priority fee to get your shipping a little bit sooner. And you got to decide, is this worth an extra $5 or $6 to get your product a few days sooner? What's driving this? It's really the bottom line for the retailer. Let's shift gears and look at City of Sioux Falls sales tax. First off, I want to thank Sean Pritchett with the City of Sioux Falls for helping supply this data here for the next portion of our presentation. This data comes directly from the South Dakota Department of Revenue. Now, this is a busy slide. There's a lot of information there, a lot of things we could look at, but what I want you to focus on is the December, every December. This is year over year monthly growth. So we start on the left side of the screen. December of 19 grew by 9% from the prior December. You fast forward to December of 20, times were a little weird. We actually saw a negative 2% growth from the prior December. Fast forward to 21, we all lost our mind. We decided to go spend all of our money, and it increased by about 27%, and it ended there at about 6% growth in 22 from the prior year. Now, overall, these are pretty impressive numbers, but are we starting to trend downward? Time will tell. Let's dig a little deeper. All right, so now we're going to look at gross taxable sales for the City of Sioux Falls. I found this fascinating. I didn't know what to expect, but for 2022, we had almost $4 billion in gross taxable sales for the City of Sioux Falls. Another interesting data point to point out is looking at the growth from 2019 to 2022, we grew by almost $1 billion in gross taxable sales. Pretty impressive. That's a 40% increase during that time. Let's dig a little deeper. So in this slide, this slide we're taking 5 retail categories, and we're gonna look at the same time frame, 2019 to 2022. So 2019 is our base year, so everything starts at 0 with year-over-year growth from there. The blue line is the total percentage change during that time frame. So if you look on the far left, lumber, hardware, and supplies grew by 60% over that time frame. I think all of us in the room would think that sounds about right. It's been a good couple years in those categories. Shift to the right a little bit. Retail bakeries grew by 112% in that same time frame. I think the city of Sioux Falls has a sweet tooth. We look at the next one, auto and home supplies. This one was an interesting one to look at. It actually grew by negative 0.6% during that time frame. I think that's largely driven by the product types for this category is likely bought more and more online. Go to the right, sporting goods stores grew by about 60% as well. That's likely driven by during the pandemic. A lot of us wanted to get outdoors more, so we bought more product from sporting goods stores. Lastly, liquor sales. We grew by 50% in 1 year. I think I know what we were all doing during COVID. And we thought, well, that's not good enough, so let's grow by another 7%, because again, this is year over year, so we grew by another 7% the following year before leveling off in 22. Now there's a movie called Anchorman that has a famous quote that says, "I'm not even mad. That's amazing." I think that applies here. All right, let's look at our vacancy rate. I'm not gonna spend a ton of time on this slide this year, but I think this is a great data point for us always to keep our pulse on. We're at 8.2% for vacancy rate in the areas that are tracked, and that's down quite a bit from 12.5% in 2021. Now, retailers have had a pretty good couple years, and I think if you've owned a retail center, you've probably felt pretty good about your investment over the last couple years. Let's look at property sales. I want you to focus on the blue line. That's the sales volume. 2021 was a record year, 120 million in property sales. 2022 still had a phenomenal year, although it's a pretty big drop from 21. It's the second largest year on record with about $90 million in property sales. I think we'll start to see this trickle down a little more before it starts to level off. Local announcements, this is always a fun slide to talk about. There's a lot of stuff happening here in Sioux Falls, a lot of retail announcements. One of the main ones that was the big news for 2022 was Dillard's. They're finally starting to work on the remodeling of the former Yonkers space at the Empire Mall. Dillard's, I researched this, Dillard's was originally announced in 2018, which feels like a lifetime ago, and they're set to open the first quarter of 2024. Now, we also saw several retailers open up additional locations throughout the city of Sioux Falls this year. Chipotle, Year-Round Brown, and of course we love sweets, so Cookie Company and Crumble Cookie, they opened up an additional location as well. Blue Tide Car Wash, Get and Go, they also did as well. Steel District and Shrappa, we're all touching on that, and there's gonna be some real exciting announcements on the retail side of things coming in the near future for those 2 projects. All right, let's look at our trends and predictions. I think our property sales numbers are gonna go down. Again, we're coming off 2 record years in 21 and 22. I think that will continue to decrease a little bit before it levels off. Our vacancy rate, we had an abnormally low vacancy rate for 2022 at 8.2%. I think that's gonna have to go up. There's some new projects coming online as well. So as the supply of product goes up, I think our vacancy rate will follow suit. New construction, we've stayed pretty steady over the last several years. I would expect that to continue for 2023. Now, customer service, customer experience, this is an interesting thing to watch. I think this is going to start to improve, and I think we can all say the last couple years have just been a little bit weird when it comes to customer service and customer experience. We've certainly had we've all had our experiences of not so great customer service, and I think by and large, we've all been pretty graceful with some difficulties in staffing over the last few years. However, there's some new customer satisfaction surveys that are really starting to point out the lack of customer experience that's been happening with our retailers. So look for retail centers to start focusing more and more on the customer experience in the years to come. Consumerism curtailment, it's kind of a trendy term in the retail world right now. There's several experts that feel like 2023 is going to be the year that buyers slow down on their purchases. Recycling products, reusing products, repairing products, thrifting, those are all things that are expected to be pretty popular here in the next year. Now, this is going to be an interesting one to watch as we continue to battle inflation and as consumer spending, consumer finances start to tighten a little bit. Where are we at on this real estate cycle? We haven't moved much since 21. We saw decreasing vacancy rates and high absorption as kind of the main factors. So I'm keeping us in this expansion column for this year. I do, however, think there could be some movement by the time we get together and meet again next year. With that, I'll invite Rob Fagnan to the stage to present on the industrial market.
Thanks, Rob. And hopefully you guys can bear with us a little bit more. It's just Nick and myself here to wrap up. So as Rob said, my name's Rob Fagnan, and I've had the honor of giving you this industrial market update for now 8 years running. And it's my hope for you to walk away with just one or two key points. That's it, just one or two key points to either help yourself or your clients be able to navigate the industrial waters ahead. Okay, so I'm going to start off by talking about one major macro trend that I've talked about in the past. I'm going to dig a little bit deeper on today, and we'll see if that trend is affecting us at all on a local level by looking at some local data. I'll make some predictions and show you where the industrial market's at on the real estate cycle. So this is an image that if you were with us a few years ago, Nick had in his presentation, and he wanted to take us all the way back to 1700 BC to show us this stone, the Code of Hammurabi. This was one of the earliest signs of documented real estate transactions back in the day. So I thought it'd be suitable to take us back to 1300 BC, the late Bronze Age, and show you one of the earliest signs of a robust supply chain. Now, this is known as the Uluburun shipwreck. It was found off the coast of Turkey back in 1982 by a Turkish sponge diver on accident. Now, what's so fascinating about the shipwreck was its trade route and the items that it was carrying. At the time of its sinking, it was known to have 20 tons of cargo on this ship, which equated to about 18,000 different pieces of raw material and finished goods from 7 different cultures throughout the Mediterranean. We're talking thousands of years ago. So that's the reason why I bring this up. Supply chains have been around for thousands of years, but it begs the question, what is the supply chain? I mean, the term itself had barely been around or barely used since prior to the 1980s. And I like Jim Rickard's description in his recent book, Sold Out. The supply chain is just a name we give to a nexus of logistics inputs, processes, transportation, packaging, distribution, marketing, customer relations, vendor relations, and a human capital that in the aggregate supports the supply and demand for every physical, digital, intellectual, or artistic artifact on the planet and in space. The supply chain is everywhere. Okay, pretty straightforward explanation, right? Not so much. Supply chains, as you probably are aware, are highly sophisticated. And they're just not part of our economy like many of us think. They are the economy. And so to simplify Jim's description or definition here, I'm going to ask a question. Is there anybody out here that likes bread? B-R-E-A-D, bread. Okay, there's a couple, yeah. I know Kurtenbach and Braden could have used some bread a year ago in Nashville. I love bread, personally. So much so that my wife and I frequently go out with some friends of ours, and they gave me the nickname Sarah Lee because of how much bread I devour. So we're going to use bread as an example of the supply chain. So most of us think of the supply chain in a very rudimentary form. Taking bread as an example, the bakery bakes the bread, brings it to the store. We pick it up at the store, bring it home, and eat it. Well, in fact, it's much more complex than that, and I'm going to use just one ingredient of bread, and that's flour, and show flour's supply chain. So in order to make flour, you need wheat. You got to go buy some wheat seeds. The farmer plants the seeds, then you water it, you fertilize it. Once it grows up, you got to harvest it with large pieces of equipment. Then you got to transport it to the processor. The processor then kicks out some flour, and then that flour has to get delivered to the bakery, and you know the rest of the story. So this is just one example of one ingredient's supply chain. Imagine the other ingredients that you need in order to make bread, or all the parts that have to come together in order for that combine to operate. Supply chains upon supply chains upon supply chains are all around us. And we were humming right along. Our modern day supply chain was humming right along until recently. Going all the way back to 1989, supply chain 1.0, when the Berlin Wall came down, we all of a sudden saw this hyper-globalization of trade. And so for a 30-year period, we saw the supply chain, build itself up. And then all of a sudden, COVID hit and really exposed the fragility of our global supply chain. And it's not just COVID. COVID's just a symptom. There are a lot of other symptoms, such as natural disasters, hurricanes, earthquakes, or power outages, can all be symptoms of the breakdown in the supply chain that we've experienced. We've been pretty fortunate here on a local level, but if you go to some of the major cities, there are a lot of shelves that are bare or empty today. So how are we going to correct this moving forward? Supply chain 2.0. Well, it's going to be a hybrid, and it's going to take time for us to build and reconstruct this transition from supply chain 1.0 to 2.0, and I'll highlight that in my predictions here in just a second. Okay, so how is this affecting us on a local level with our local industries, manufacturing, warehousing, transportation? Well, I'm going to start off by talking about our overall industrial universe. In other words, the total square footage that makes up the industrial market in our area. As you can see, our universe grew by just over 5% this past year, pushing us past 30 million square feet of industrial space in the area. Now, what's pushing all this growth? Well, several large projects, but I want to highlight the two larger pictures, the docks and Alloy 1. This is the city's first ever 100,000+ square foot precast concrete spec buildings in our town. And there were two competing Fargo developers that came down to Sioux Falls and were willing to bet on the strength of our local economy. So those projects are underway, and I wouldn't be surprised to see those backfilled before the end of the year. A couple other notable ones, Outdoor Gear, 50,000 square feet up in Development Park 8 was finished this past year, and then CCL Label built a 117,000 square foot building just south of Jefferson's new high school out on the west side. Now that's for Sioux Falls. Is anything happening in the surrounding area? Absolutely. Thornton Flooring building a large 90,000 square foot building just off the T exit, and you can see that as you're driving up and down I-29. And out in Brandon's new industrial park, Hague's modular manufacturing facility wrapped up this past year, 120,000 square feet. So a lot of large projects going on. All right, I wanted to look at a historical chart of all the new construction that's been taking place over the years. And my eyes immediately go to this almost 70% drop in new construction. Nothing to be concerned about there. As most of you know, in 2021, that's when Amazon was built, approximately, right around 3 million square feet. So if you were to take Amazon out of the picture, 2022 would have been the largest year on record for new construction in industrial. What's driving all this new construction? Well, as fast as it gets built, it's being absorbed. So as we continue to absorb more and more space, companies are forced to have to go out and build new, or developers. So we got all this new construction going on, all this absorption. It's no wonder why we're seeing continued record low vacancies, sub 3% at 2.56% for Sioux Falls. Now, much like Alex had in his presentation, when you compare Sioux Falls to the national average, we historically have always been below the national average. So we've always been a pretty tight market, but also a very healthy industrial market here in Sioux Falls. Okay, let's shift gears, just take a look at some property sales. For 2022, we had 50 total transactions of existing industrial buildings. Now that surprises me a little bit, because usually when you see all this new construction taking place, it's because there's no availability of existing product out in the market. And so that actually wasn't the case in 2022. We saw a slight uptick to that 50 mark, totaling about $114 million in total dollars being spent. Now this is the first time that we've ever seen that sales volume spike up above that transactional bar graph. And the simple story there is that companies are paying much more on a price per square foot for industrial property than they ever have in the past. A few examples of this. Traditionally, over the last decade to 20 years, industrial property has traded for anywhere from $20 to $80 a square foot. As you can see, that margin is widening significantly. Of those 50 transactions I just talked about, almost half of them were over $100 a square foot this past year. And these range anywhere from $24 a square foot for an old World War II warehouse up in the old airport industrial park, to a flex industrial space at $121 a square foot, all the way to a meat locker out on the east side of town at $185 a foot. So property sales on the industrial side have been very healthy this past year. Is that converting over to the leasing market? So quickly, just to set up this slide, these are asking lease rates on a price per square foot for Class A, B, and C industrial space. And these are the upper ends of those ranges. Reg talked about inflationary cost of construction, and we're seeing that pass through to industrial lease rates. Past couple of years, we've seen anywhere from a 10 to 15% increase in rates. And so there's none of this mixed signals that Reg talked about in his presentation for the industrial market. What is happening and is supposed to be happening is happening in this market. So very healthy market these past couple of years for industrial. All right, predictions, new construction. We were at 1.2 this past year. I think we're gonna have another strong year. You drive around town, there are a ton of industrial projects being built right now. And so we'll continue to see another strong year in 2023 for new construction. Vacancy, we continue to absorb all that space. I talked about that a second ago. So I think we'll still stay in that 2 to 3% vacancy range. Lease rates and sale prices, they gotta continue to go up with just the cost of construction and where rates are at. Sales transactions, they'll more than likely be down for 2023 because we've seen just such a lack of product available out in the market for somebody to go purchase. Now, supply chain 2.0, what's that going to look like? I said it's not going to be easy, and it's going to take a long time to try to reconstruct what that looks like. But I think what's going to happen is we're going to see a move where we are decoupling ourselves from a lot of totalitarian societies around the world. And what'll end up happening is we'll essentially have a college of nations that come together that have very similar values, from a trade standpoint, democracy, human rights. and infrastructure will get built out around that College of Nations. And it may be a little bit more costly in the future for product, but we'll have a much more stable supply chain. And again, this is going to take a long time for supply chain 2.0 to play out. But I will track this in the years ahead and report back in this presentation. So where's the industrial market at on the real estate cycle? We're smack dab in the middle of expansion in 2022. The only bullet point that didn't happen was vacancy rates going down, and that's primarily due to a couple of the large spec projects that I talked about. But we're seeing high new construction, high absorption, employment growth, and rental rate growth. So I think 2023, we're gonna stay in that expansion column, and it'll be another great year for industrial. So with that concludes my presentation. I'm gonna bring up our cleanup here to talk about the fun stuff.
Well, thanks, Rob. In this portion of our presentation, we focus on investment properties. The first thing we're going to do is we're going to take a look at the national, what's happening on the national scene, macro trends. We'll drill down to what's happening here in Sioux Falls. We'll take a look at individual transactions that give us good examples of cap rates that happened the previous year. And using these inputs, we'll make some informed predictions about this year. Unfortunately, our clients know that commercial real estate's not the only asset class to invest in. As investors ourselves, we know our clients have many options when it comes to investing in their capital. Some of these common asset classes, equities, bonds, cryptocurrencies, commodities, or even the business that made the money in the first place. And a quick glance at 2022 returns show that last year was kind of a tough year. Inflation. We are sick about reading articles about inflation. We're sick of talking about inflation. But here's the big thing. The Fed's reaction to these inflationary trends are going to drive the commercial real estate market here for the next couple of years. This is a 5-year chart showing inflation all the way back to 19. Now, when we take a look at what's happening at the beginning of 23, core and overall appear to be trending down. And this is great news. But let's remember this is a year-over-year measurement. There's a lot of price increases that are baked into the system over the last 2 years. Inflation is not yet tamed. One of the things that it's really important to take a look at for the future is the money supply. Why do we care about the money supply? It's a measurement of liquidity in the system. That's cash, money in checking accounts, and money markets, and CDs. This goes all the way back to 2007, and you can see that dark bar is the M2 in trillions. It's no secret that the federal government airlifted a lot of capital into our economy over the last 2 years, but this was a $6 trillion liquidity event. That's about $20,000 per person in the United States. Wharton economist Jeremy Siegel is blaming, in a recent panel discussion, is blaming a lot of the inflation that we're seeing right now here in the United States on this $6 trillion liquidity event. The big takeaway here is inflation might be with us for a lot longer than we'd like. Yield. We're going to talk a lot about interest rates. In fact, we're going to do a test fit on an individual property. But one thing to take a look at is the yield in US money markets. Over the last decade, if you had money in a money market, you're not getting much yield. But suddenly, over the last couple of months, investors are getting nearly 4%. Just having their capital sit in the money market. Why do we care about that? Well, investors have had to go out and take risk to get yield over the last decade. Now that 6% cap rate property may look less attractive to an investor if they can just keep their money parked in a money market, not have to borrow and not have to take risk. That's going to diminish investors' appetite a little bit for commercial property transactions. Interest rates. A year ago when we stood before you, the federal funds rate was essentially at 0. Now it's hovering just under 5%. The 10-year Treasury, which is kind of a benchmark risk-free yield in a 10-year US Treasury, it was at 1.6% a year ago. Now This slide, we had to update this slide 4 or 5 times in the last month. Yesterday, it was over 4%, 10-year treasuries. The secured overnight financing rate was about at 0. This is replacing LIBOR, and this is hovering just under 5% as well. We're going to spend the next couple of slides talking about CMBS. What's that? Why do we care? It's a commercial mortgage-backed security. Basically, it's a bond. It's a bond collateralized by a commercial mortgage secured by a commercial property. Banks often will sell their commercial loans to Wall Street. Wall Street will package them up and then will sell them to investors. Principal and interest payments made by the commercial property owners will pay the owners of these bonds a yield and will give them back their principal. Why do we care? This commercial mortgage-backed securities market makes up about 20% of all commercial loans out there. And here's the thing that's cool about them. Because elements of them are publicly traded, we can see how delinquent they are. A lot of local banks here in Sioux Falls, I have no clue how their loan portfolio is doing unless I'm on the board or unless I'm an employee. But we can actually take a quick look at the CMBS market and see how delinquent loans, commercial real estate loans are. And it gives us an idea of health. The delinquency rate is kind of the green bar dotted. And this goes all the way back to 2008. And you can see in the recession, this peaked at about 11%. 1 out of 10 commercial real estate loans was delinquent. All right? Then we had a nice downward trend. And then we peaked again in COVID. And we were right around 7 or 8%. And that's gone down to about 3% right now. That's actually great news. 3% of commercial mortgage-backed securities are delinquent. That sounds actually pretty healthy. Let's take a look at asset classes in these commercial mortgage-backed securities. If we take a look at the very far bar here in December, that 3% vacancy, which looks pretty healthy, if we start taking a look at industrial, there's almost no delinquency in industrial. Lodging is about 4.4%. People have kind of changed the way they travel a little bit. Some of those hotels are struggling a little bit. The worst asset class right now is retail at 7%. There's a lot of bad office headlines, but look, they're only at about 1.5% delinquent. Right now, this is actually a sign of health for commercial property owners. Their buildings are mostly full, and their tenants are paying their rent. Here's an early warning sign. We keep talking about commercial mortgage-backed securities, and these are issuances in January and February of every year going back to 2016. There's an 85% drop from last year. And it's the lowest amount going all the way back to 16. This is an early warning sign that there's not going to be as many sales transactions this year compared to last year. We always take a look at loan maturities. Why do we do this? Well, when you borrow money to invest into commercial real estate, typically, not always, typically it's a 5 or 10-year loan term. And if you want to hold a property long term, you have to refinance your loans every 5 to 10 years. So we've got banks, insurance companies, commercial mortgage-backed securities, a whole bunch of different loans out here in commercial real estate going back to 2009. The big takeaway on this graph is in 2023 and 24, there's going to be about $1 trillion worth of loans that are going to need to be refinanced. Unfortunately, some of these commercial property owners will have to inject capital into their loan refinances, and that might be interesting. The world loves real estate. This graph shows dry powder, and what do we mean by dry powder? That's the amount of capital that's been set aside to invest into commercial real estate globally. And this trend line starting in 2000, every year the world is investing more and more capital into commercial real estate. The amount of dry powder or capital sitting on the sidelines waiting for a deal right now is about $400 billion. Historic national cap rates. There's a lot going on this slide, but what we have is office, apartments, industrial, and retail cap rates. Cap rate is a measurement of yield, net operating income divided by the purchase price, going all the way back to 2012 on the national level. And the trend line has been prices have been rising and investors have to accept less yield in their transactions. All that started to change in the last quarter of 2022 because interest rates started to go up. This is the commercial real estate investment measurement in dollars, in amount of transactions that occurred in the United States, going all the way back to 2007. You can see very quickly on the far right, 2021 was the biggest year on record with $800 billion worth of transactions. And last year was a close second at $700 billion worth of transactions. That's incredible. Let's recap a little bit on the macro section here. Last year was the second best year on record. That's awesome. Here's the problem. I'm predicting a significant slowdown on the national level in 2023 because of a math formula. It's a math problem. We're going to take a look at that more on that in just a moment, okay? Right now, we're experiencing very high interest rates. Capital has become much more expensive, but what's going to force a seller to take less money for their property? Well, right now, nothing. 99% of commercial mortgages out there are well under the current rates, all right? Buildings are full, cash flows are great, and a lot of these property owners have 3 or 4% mortgage rates. Life is pretty good. Let's take a look at an individual property. Now, we decided to take a look at a Starbucks in Morton, Illinois. Everyone likes Starbucks, right? We took a look at our taxes last week, and I was embarrassed how much money we spent at Starbucks, okay? So Starbucks is a great company. They create a great product, and we love walking into Starbucks. We love doing a drive-through at Starbucks. This is a property that was a brand new property in Morton, Illinois. We didn't want to hurt anyone's feelings here in Sioux Falls, okay? This is a great property. It's 2,000 square foot. It's brand new. It's on the market, or it was recently on the market for $2.2 million with a 10-year lease. Okay, great. Let's do some test fits. In January, let's go back in time and buy this property in January. In January, we're gonna buy this property at list price. We're gonna put 25% down, and we're gonna have a 3% interest rate, a 25-year amortization. This deal is going to give us a 4% cash on cash. We're gonna do a couple slides here, so assumptions are on the left and our worksheets on the right. A lot going on here, but this is a 4% cash on cash deal a year ago. A lot of investors out in the audience may not get excited about a 4% cash on cash, but remember, when this deal would have been done in January of last year, the 10-year treasury, the risk-free yield, was at 1.6%. This deal pencils. Let's fast forward to February, last month. We're gonna take the same property, we're gonna buy it at list price, and we're gonna use the same assumptions, but instead of a 3% interest rate, we're gonna use a 6.25% interest rate. So for the honor of investing $560,000 as your down payment, you're going to lose $15,000 every year. I think I'm pretty good at selling real estate, but I don't know if I can sell this deal. Okay, this is a 3% negative cash on cash. This deal doesn't pencil. Okay. How much do we have to put down to make this deal pencil? Well, that's 34% down. Okay, so if we invest $800,000 in this deal, we're going to cash flow at zero. Well, that doesn't feel very good. If you invest $800,000 in a property, I think you want a return. Okay, let's try to negotiate on price. That happens, right, in real estate, right? There's an offer, counter offer. Let's try to renegotiate this. With 25% down and a 6.25% interest rate, let's drop the price down 29%. That's reducing the price on this transaction down $640,000. That's gonna give you a 4.5% cash on cash. All right? This deal feels better, but let's remember, a 6-month treasury is at what, 5%? No one did anything wrong here. The developer who developed this Starbucks, they didn't develop this property at $2.2 million. They developed the property for much less. So what's gonna happen is this seller's probably just gonna hold on to the property. The buyer's not gonna buy the property. Nothing's wrong. Building's a great building, great tenant, but it's gonna be a pause on this transaction. All right, let's take a look. My colleagues did a great job taking a look at office, retail, industrial, land. Let's take a look at multifamily and drill down on some of the trends that we're seeing. The very first thing that we're gonna take a look at is new unit construction. This goes all the way back to 2013, and you probably noticed driving around Sioux Falls, 3,300 new units of multifamily last year. That's pretty awesome, right? Now let's remember, Reggie's slide showed 7,000 people moved here last year. This makes sense. Let's drill down a little bit further into total cumulative units. And what do we mean by total cumulative units? Duplexes, townhomes, single family, multifamily. 4,300 new units last year. That's awesome. Are we overbuilding? This slide answers that question. This gold bar is Sioux Falls multifamily vacancy going back to 2007. And right now, we're under 4% vacancy. So the answer is no. We're not overbuilding the Sioux Falls multifamily market at this point. It's a nice contrast to the national market. We're looking pretty good with multifamily. In fact, we're looking really good. This is the Sioux Falls multifamily sales volume slide. Each bar shows sales transactions in dollars. This goes all the way back to 2007. In 2022, there was about $160 million worth of multifamily transactions. Wow, that's incredible. That's a big record. There were 48 transactions, 4 units and higher. Now, the average price point, when you take all these properties and divide by the total units sold, $105,000 per unit. Note, to build a brand new 2-bedroom apartment right now is about $200,000 a unit. Now we're gonna take a look at specific transactions. We're gonna go through these really fast, okay? The big takeaway on each one of these are cap rates. South Willow Avenue sold, South Willow Apartments, $3 million transaction, 6% cap rate. Lakeport Village, I lived here for a year in college, believe it or not. $3.6 million, 5.6% cap rate. West 41st Commons, big transaction. $29 million or 167 units, 4.5% cap rate. Dolly Retail Center, nice retail building, east side of town, $5 million at a 6 cap. Liberty Square, 2 really great strip malls, south side of town, $12 million transaction, 6% cap rate. Doral Center, nice looking office building south side of town, $5.7 million, 6.29% cap rate. Avera Professional Plaza, this is on the corner of 33rd and Cliff. Avera's the tenant in here, long-term lease, $2.5 million transaction, 6.29% cap rate. Alex touched on this in his presentation. 2 buildings here, Class C, $4.2 million, 6.9% cap rate. We have a hotel comp in here, 9.63% cap rate. Perhaps the largest transaction in our market last year was an industrial building leased by FedEx, $65 million transaction. This was at a 4.8% cap rate. We have a nice looking storage center here, $7.8 million at a 6.5% cap rate. Let's make some predictions. 2023 is going to be a pause year for a lot of investment transactions. Is this a doom and gloom prediction? Absolutely not. We're busy, we're doing transactions, but some of the transactions that might have happened a year ago at 3% interest rates, they're just going to pause this year, okay? I'm predicting that Investment sales transactions in Sioux Falls will be down roughly 40%. And the reason I'm predicting that is simply interest rate and yield math. Owner-occupant transactions, we've noticed at several of our closings this year that owner-occupant transactions seem to be accelerating, and macroeconomic trends are going to strongly influence our market this year. What do I mean by that? If the Fed continues to aggressively raise interest rates, we are definitely going to feel that here in Sioux Falls in our investment sales market. Multifamily sales are going to come down from the record that we saw last year of $160 million. That's math, everyone. Multifamily construction, this is really interesting. So we have a lot of new product that are coming online just in the next couple of months, probably the next 6 months. Vacancy rates are going to spike a little bit. They just have to. We're going to be probably about 6% vacancy mid-year, and then they're going to drop back down. And the reason we can predict that is, number one, we know it's becoming more costly to borrow money to build new units. Number two, construction costs continue to rise, all right? It's getting harder and harder to pencil some of these deals, and we're going to see down from that 3,300 new multifamily unit number, we're going to probably see about 12 to 1,500 new units get built, and that's simply going to be due to cost of construction and interest rates. And finally, cap rates on the deals that we do see happen this year, they're going to be up. They just have to be. With that, this is the final slide. When we take a look at the multifamily real estate cycle, 2022 is firmly in between expansion and hypersupply, and we'll end this year in 2023 about right there as well. With that, I'd like to bring Reggie up to conclude our presentation.
Thank you all for staying with us. I said from the top, we love this city, we love this state. We made some 605 hats. We've got some other hats out there. We hope you take one. And one final thought, okay? And I want to be like Oprah and start sending a few out of these. You get a hat, you get a hat. One final thought. For the last 24 to 36 months, it's been a meat grinder. We've all been busy. This entire market, every service-based business has been working incredibly hard. A recent buddy of mine said that he felt like he'd been driving 130 miles an hour down the interstate for the last 2 years, and he was ready to drive 80. He didn't have no off-ramps, no brakes, and he's just ready to take a step back. I think this is a year we get to drive 80. And with Microsoft Teams and Zoom and hybrid work, it's created a very transactional feel in the office today with your clients and with your team. My challenge to everybody is to reconnect with your people, reconnect with your clients. You're gonna have a little bit more time this year. And with that, we're wrapped up, and happy hour is out there and the hats are out there too. So thank you again for coming. Thank you.